Just because you're paying $3,000 a month in rent doesn't mean you're necessarily going to qualify for that same amount when you apply for a mortgage. So last month I had a small business owner reach out to me. He was renting a nice apartment in Phoenix for about $3,000 a month, and it was comfortable for him. His goal was to stop renting and buy a home. When we finished his pre-approval analysis, we found out that he qualified for about $750 less than what he'd been paying in rent. He was a little frustrated and confused and asked me, hey, if I can afford a $3,000 a month payment, why am I being approved for less? I'm going to tell you exactly what I told him. The first reason is that the timeline is longer. The landlord or property manager is only concerned with your ability to pay back the rent within a 1 to 2 year period. Mortgage companies and lenders are looking more at the long term at your ability to repay the loan. Next is your income and your debts. A landlord should do a credit check and peek at your pay stubs, but they're not going to do a deep dive into your money to find out how much money is coming and going. A mortgage lender does a thorough review of your credit and your debts and wants to look at a 2-year income history. If you're self-employed, be prepared to supply your tax returns, a profit and loss statement, and a bunch of other documents that aren't required if you were renting an apartment. Ultimately, it comes down to risk. Signing a 1 to 2 year lease is totally different compared to a lender lending to a complete stranger hundreds of thousands of dollars. Lenders are always going to be much more conservative in their approach, which is why it's easier to qualify for a higher rent payment than it is a mortgage payment.